Today, we're going to be sharing our deep dive evaluation analysis on three different popular stocks right now. HIMS, which has been flying recently, Tesla, which has been a darling and is a Mag 7 stock, and Lemonade, which is personally one of my favorite investing opportunities in the market today. So, we're going to be going over our valuation metrics, talking about our revenue growth expectations, profit margin expectations, valuations, so potential returns for each of these three stocks. My name is Jacob. This is How to Invest, and I'm here with my brother, Aaron. Welcome.
Welcome in. Yeah. Thanks for joining us today.
Yeah, so Aaron, you want to start, and we'll just very quickly, I guess, some background on me before Aaron jumps into the numbers. I've been investing for 6 years now, and have averaged 70% annualized returns, which especially early on was a little bit of luck, I will admit. But I love investing. I love researching into companies. I love looking at what I think a company is going to do in the future, revenue wise, earnings wise, world change wise. It's one of my passions. And Aaron, you want to introduce yourself a little bit?
Yeah. I kind of got into investing a little after Jacob did. Just been learning. I've always heard about investing growing up. Obviously, it's a way to definitely change your future a ton. Um, yeah, it's a good thing to learn for sure. So I've been getting up to speed, learning a lot, trying to catch up to Jake a bit, and just in terms of knowledge and all that. But I think, yeah, we're value investors, we're story-based investors. So we're just going to kind of go over our story for these three stocks.
Cool. All right, you want to bring us into HIMS?
Yeah, Hims is, you know, a consumer first medical provider, basically pharmacy, online pharmacy, originally focusing on men's sexual health, and then they've expanded to a bunch of other health verticals over the last couple of years. They have the Hers brand now as well for women's different for health verticals there as well as sexual health, weight loss. Then most of these are for both Hims and Hers. So both of these brands offer a lot of the same health verticals, and they're expanding to more and more health verticals. So they're direct to consumer, consumer focused. They don't take insurance, which is a huge differentiation between them and other pharmacies. But surprisingly, they're still able to offer costs that are usually less than what they would be people would be paying with insurance, which is really revolutionary and super deflationary for the healthcare industry. So I think overall, really, revolutionary company. Um, they're one of the first companies to be focused on the consumer because a lot of these current um, medical companies and stuff, it's more about pleasing the insurance or how we're making as much money as you possibly can, like regardless of the consumer, because the consumer historically hasn't had very much choice in these things. You get an insurance plan, the insurance tells you what PCPs you can have. You go to your PCP, they refer you to, you know, uh, a specialist. It's just whatever the expert thinks is best. So this is really giving the choice back to the consumer for the first time in the health industry, which is really revolutionary. And I think people are really realizing that, and it shows in HIM's numbers. I don't know
Yeah,
if you have anything to
and
add to that.
well, I just wanted to say one thing I love about him is Andrew Dudum, the CEO. He just has like some incredible experience. Before him, he was literally just kind of like running a startup incubator that was just launching, business after business after business and trying to scale, multiple businesses every single year from scratch. So he just has that sort of mentality and leadership skill to just continue to launch like new healthcare vertical, new healthcare product, new healthcare vertical, new healthcare product. And that is one of the reasons why HIMS has such strong revenue growth looking out long term, because they're just going to continue launching in new verticals, and their current verticals are still growing as well. So HIMS is one of those businesses that just has a lot of long-term opportunity connected to it. Partly because of the total addressable market, because it's in such a big market, but then the management team's execution inside of that market and some of the advantages that you were mentioning and benefits of HIMS that you were mentioning as well. So
Yeah.
yeah, starting off on our revenue expectations. It was actually quite easy to predict out HIMS because in Q1, the leadership just gave their 2030 guidance. So for this year, the high end of the guidance is 2.3 billion. They'll probably beat that. Probably get a like 2 point, maybe 2.4 billion, something like that. Um, and then the management guiding out to 2030 is expecting 25% or 22%, something like that, annual revenue growth from 2025 to 2030. So that next 5 year period. Um, Now
And
I
I
think
think
that's
they're
a
really sandbagging that too.
yeah, I think they're a little
Yeah.
conservative as well. So for our numbers, I put 30% annualized top line revenue growth, which is 8% higher than the management is guiding for. So I think management said like 6.5 billion in expected revenue by 2030, and our number is 8.5 billion. So we're expecting them to beat that by several billion dollars in revenue. And then going out another 5 years, so the 10-year forward revenue outlook, we're expecting them to continue growing, but that revenue growth to slow from 30% to 20%, so that by year 10 they hit around 21 billion dollars in revenue. And then looking way out, which we should throw out the caveat that all forward estimations are just that, estimations. We're not going to guess perfectly right on any of this. But we expect revenue growth to continue actually quite strongly for our numbers the next decade. We expect HIMSS to continue putting up 15% annual revenue growth numbers and to hit $86 billion in revenue 20 years out. So,
These are huge revenue numbers. The question then is how are they going to hit this? So verticals, healthcare verticals are just like basically a consumer pain point. So maybe like obesity, diabetes, sexual health, um, like testosterone. These are all like different health verticals that HIMS can launch into. They're in a lot of these verticals already for women, like uh, period care, peptides. So peptides is a new upcoming industry that can, it's like a protein based way to solve a lot of these acute pain points.
yeah,
And
there's
so
just
they
a
can,
lot of TAM. There's a big total addressable market.
yeah. And then also they have a lot of data on their consumers. And so they can make really, really good AI doctors. And we can already see AI is already better than a lot of doctors in, detecting broken bones, detecting cancer, even doing surgery in some cases. So it's not that big of a leap to think that eventually we're going to have AI doctors and they might have one of the best offerings because they're going to have the best data. So yeah, I think in the future their growth rate may not even decelerate as much as we're like predicting that it's going to decelerate because they're going to be launching these new huge fields like AI doctors. I
Yeah,
think that
there
has a,
is a law
a
of large
massive
numbers,
TAM.
though. It's
Yeah.
hard to keep growing at the same speed once you get to a certain size. So the revenue growth rate definitely will slow down over time, but it is impossible to know exactly how fast it's going to slow down.
Yeah.
Or, whether or not they could have something massive, where like their revenue growth was already slowing down. It already looked like they were going to be in the low 40% revenue growth range. And then this massive weight loss boom happened, where they were able to start, compounding
Yeah.
liraglutide and
Yeah.
accelerated their
GLP-1s.
revenue growth from 40% to 100%,
Yeah.
so
Yeah.
you never know.
And
You never know exactly.
yeah, definitely. So, did you go from the revenue to margins and then also earnings multiples? Are
Yeah,
we going
so
to go over
profit
that?
margins right now they're about 9.5%. So 5 years out, we're assuming they'll get to 15%, 10 years out, 21%, and then 20 years out, 25% profit margins, which is the midpoint of the guide, which is 20 to 30% EBITDA margins. So we're it's maybe a little bit saying they're going to beat that a little bit. They're going to maybe at like 35% EBITDA, which might be 25% net margins, something like that. Or maybe 30% EBITDA could be 25% net margins. It's
Yeah.
just giving us a ballpark.
And for multiples, we're expecting some compression on that end. So that I don't know exactly what their PE ratio is, something around 60. High growth companies demand a bit of a higher PE, but In 5 years, we're expecting to be around 50 and then compress to 35 and 10 and then 30 and 20 because they're still going to have a pretty good growth rate even in 20 years. So, um, and based off of all of that data, revenue, margin, and PE ratio, we can kind of guess what kind of return on every dollar you'll
Yeah.
get for every dollar invested in the stock in 1, 5, 10, and 20 years.
Yeah, cool. So we'll show those expected multiples, those expected returns on the 5, 10, and 20-year period in a minute, but quickly let's go over Lemonade and Tesla as well. Kind
Yeah.
of same deal. So Lemonade right now,
You
uh,
want to explain what lemonade is first?
oh yeah, sure.
I forgot that for him, so we should do that. You want me to do it?
Yeah, I was just listen, insurance tech
Yeah.
company.
Yep. Not too
AI
complicated.
insurance company. It's literally just an insurance company that's trying to sell all liability insurance. They're already global, so they're in the US, Europe, and the United States already. And then they're trying to automate everything. Um,
Yeah.
and we have way more. I literally am recording some super in-depth videos on Lemonade, if you want to learn more. So let's just go over their revenue here.
Okay. Yeah. So Lemonade reported 526 million dollars in revenue. I think that's year end 24. Let me double check that. Yes. So
Yeah,
year end 24, 526 million in revenue. This last quarter, they did 151 million in revenue. And then do you
yeah.
want to
So
explain the revenue versus enforced premiums? Because that's a pretty big
yes,
part of the story here.
yeah. So Lemonade right now, so they have $1 billion. They have a little over $1 billion in enforced premium, which is the total dollars in premiums that they're collecting from insurance customers on an annual basis. But they currently do rely on reinsurance because they're still a small insurer. So in order to mitigate some of the risk, they cede some of that premium to a reinsurer. So that reduces the amount of revenue that they're actually collecting. So their current revenue collected, or for this year, we're expecting it to be about around 673 billion. Sorry, 673 million. 637 million on 1.2 billion in premiums. So they're sitting about half of their premium revenue to reinsurers and are not claiming it as revenue now, but it will be future revenue because once they get profitable, once they no longer need to mitigate as much of the risk, then they can claim all of their book of premiums themselves and claim all that revenue. So there's kind of some built-in inherent revenue growth that Lemonade is going to get for free as they start to close the gap between revenues and enforced premiums.
Yeah, like if they decide today, they could literally double their revenue basically
Yeah,
if they wanted
almost.
to take the additional risk. So we're assuming that they're going to unlock that over time. So not at any point they're just going to stop reinsuring the other half, but they'll probably start compressing that percentage from 50 to 40 to 30 to 20. But what percentage is the enforced premium growing at?
Their enforced premium has been growing a little like in the mid 20% digits, and
Yeah.
they're guiding it to grow in the 30% plus range from 2026 and beyond.
So these might
As
actually
a
be a little bit conservative then. If their enforced
as a
premium's growing at 30%, then
Yeah, so over the next 5 years, though, so Lemonade's not going to be profitable till 2027, gap profitable. They just hit cash flow profitability, free adjusted free cash flow uh, in Q3 and Q4 of 2024 for the first time, and then they'll hit EBITDA profitability in 2026, and then they'll hit gap profitability in 2027. So I don't expect them to actually start reinsuring less in the next 5 years. So the next 5 years, they'll probably keep reinsurance about the same until they actually start really growing their balance sheet because they still have another couple years of book value compression until they hit gap profitability. So they're not going to be stopping the amount of reinsurance that they're doing over this 5 year period. So then I include some of that some less reinsurance than from the 5 to the 10 year. So from 5 to 10 years from now, because they'll be profitable 3 years from now, got profitable 3 years from now, then they have 2 more years of growing that net margin, and then the next 5 years they're super profitable. They're getting more and more profitable, and I think that's when they start to do less reinsurance. So we just have 30% annual revenue growth for the next 5 years. So from 6.73 million to 2.8 billion in 2030. And then 2035, we're up to 12.757 billion. So this does assume some revenue growth above 30% as the IA growth, as the IFP growth. I have calculated continues to cruise at 28% and then revenue catches up to IFP.
And then the 20-year, from year 10 to year 20 years out, we're expecting the rev to slow down after they've stopped the reinsure and now revenues grow at enforced premiums. We're saying it's going to probably grow around 15%. And I think that's just kind of our assumption basing on team execution, new markets they can go into, new verticals of insurance they can go into. They can insure, you know, more cars and whatever, because mainly they're just doing pet insurance and renter insurance right now.
Yeah,
So
I mean, yeah, I'm trying to be conservative here. I think we're being conservative for Hims and Lemonade for both of them, which I think is a good thing. But Lemonade is quite a bit smaller, so technically it might be able to grow slightly faster for longer
yeah,
than Hims. But neither of them are actually that large yet. That they both have the ability to grow, many multiples from where they are. So profitability.
yeah, talked about already a little bit. Yeah, in 1 year, obviously they're still not going to be GAAP profitable, so we had 0% profit margin, which does make the 1 year return kind of harder to guess. But in 5 years, we're expecting them to get to about 70% profitability. Um,
7%, 7%.
Sorry, yes, 7%, not 70. That would be incredible, but
Yeah.
there's no way that's going to happen. And that's just assuming they're growing revenue at 30% a year, but their OpEx stays flat. And the reason
Yeah,
we're assuming their
OpEx
OpEx,
excluding growth spend
yeah,
stays flat,
um,
stays flat. Sorry.
and we're assuming that because that's what they've been doing incredibly. It's pretty insane to look at the rev growth compared to their OpEx, excluding growth spend. It's pretty much flat, and in fact, they haven't hired anyone in like a few years now. Their workforce has been shrinking just from like basically natural turn.
Yeah, they have been hiring some people, but the churn has
Oh,
been a
okay,
little bit faster than
that
the hiring.
changed. Oh yeah, yeah, that's a good point. Yeah, so that they haven't been increasing the number of employees. They've been rehiring. Obviously, if a critical position leaves, they need someone in that position. Um, so yeah, that's definitely good correction there. 10 years expecting 12%, and then in 20 years we're expecting 18%. Um, and that's just an assumption through automation. Premium payout is below 65%, and OpEx is 15% of revenue. You want to give a little bit of a breakdown of where we get 15% of rev OpEx and how that compares to other
Well, so
insurance
so
companies?
a traditional insurer today, like talking like the Geicos, Progressives, all states of the world, normally their operating expenses, so the cost of operating the business as a percentage of their collected premiums, it can be 20% plus of their premiums. They just blow running the company, paying everyone's salaries and stuff. But Lemonade is going to be far more autonomous than the traditional insurance companies. They're guiding to $4 million in enforced premium per employee. Lemonade is, whereas a traditional insurer would have about $1 million of enforced premium per employee. So 4 times more enforced premium per employee. A lot more efficiency. Not having to pay insurance agents because Lemonade is direct to consumer, so that cuts out some of the expenses as well. And then being able to underwrite or price even more accurately because of AI doing it instead of having to rely on thousands of actuaries, which is also more expensive as well. Just like the actuaries themselves cost more. So the assumption is, and then Lemonade is doing a lot of like really smart stuff that allows them to get better data. which allows them to then price even more accurately, like having your phone telematics so they know if you're texting while driving while you have your car insurance with them, or whether or not you're breaking the speed limit through the phone telematics. And they just get a lot of extra data that traditional insurers, while they're trying to get it, but really the big insurers are only using this extra data on less than like 3% of their policies. So yeah, they'll have less losses and less operating expenses as a percentage of premiums because of AI, and that's going to allow their profit margins to be closer to 18%, maybe 20%, instead of the like 10% that traditional insurers have as a profit margin today. Um, that's kind of what we're thinking.
Yeah, and they can't have a premium payout above 60, like below 65%, because any if the premium payout say is 60%, they have a pretty much an agreement with their consumers that they'll donate the difference to charity. So I think their premium payout is probably going to be way below 65%. So this company is going to be printing money for charities, which is pretty cool as well.
Yeah. So if you do something like a 65% claim claim ratio or expense ratio, and then a 15% operating expense ratio, then
Yeah,
you get a combined ratio of 80, which would give you a profit margin of 20%.
yeah.
Not
So
including, by the way, profit from float, which reinsurers can invest all the float of the premiums that they're currently holding, um, which
yeah,
can provide additional income as well.
yeah. So these margins might be a bit conservative, honestly. That's definitely not the bull case margins here. I would say in general these are base cases for us.
Yeah,
But yeah,
although like
move,
a traditional insurance analyst might say this is super aggressive to assume an 18%
yeah.
profit margin. So
But we
it
haven't
depends
seen
how you
anything
ask.
like AI before, so I think
Yeah.
it's just another whole game. Talking about earnings multiples here, if you were saying they were profitable right now, it would be like something like over 200 PE ratio right now is obviously very expensive, especially for an insurance company. But when they do hit profitability in 2027, it's going to be like pretty high PE ratio. But we expect that to come down pretty quickly as revenue continues to grow and obviously their net margin begins to grow rapidly. So we're expecting that to compress to 50 in 5 years, 35 in 10 years, and then to 25 in 20 years, which is more in line with traditional insurance PE ratios, but also giving them a bit of a bonus there for potentially still be growing at 15%, as well as being having a much higher net profit margin than other traditional insurances, going from their typical insurance company having a 10% net margin to Lemonade assuming around an 18% net profit margin.
Yeah. Okay. So once again, just like with HIMS, we'll show you the expected returns based off of these expectations in a minute. We just have one more stock to cover really quick, which is Tesla. Doesn't need much explanation. I think most people know what Tesla is. They produce EVs, energy. Their mission is sustainable abundance. Eventually, they are going to be doing hopefully vast global autonomous taxi networks as well as humanoid robots.
Yeah, it's a pretty cool story. This is definitely not one Peter Lynch would be super happy about. This is a very, very exciting company story for Tesla. Peter Lynch likes boring stories. So, but this one is gonna, I think, change a lot of people's lives. It's gonna change, how a lot of people interact in the world too. So, this is an exciting story, and we just think there's going to be such a good return on it. We're kind of like we gotta be invested in this.
Yeah,
Obviously, Tesla.
at the same time
Go
though,
ahead.
because of those facts, it has to outgrow the biggest current multiple valuation
Yeah,
out of all of these stocks.
yeah,
And it has to do that while currently having the slowest backwards looking like last 12-month trailing growth rate. So it has
hmm
the slowest current revenue growth rate and the highest current valuation multiple. So I understand why a lot of people do think Tesla is very expensive and not attractive right now. However, we are assuming that things are going to turn around quite a lot. Tesla is still in a price range where 95% of the automotive market cannot afford them. So cheaper models still unlock the vast majority of the automotive market for Tesla. So there's still a ton of unit volume growth ahead for them just by pushing prices down. I also think that autonomy is going to bring a lot of incremental profit because it's software revenue, largely, and is also going to make the demand for buying the cars higher, unless, eventually Tesla decides not to even sell the cars anymore because they can just make more keeping them and just deploying them all around the world with autonomous taxis. And then, yeah, there's just a lot of like really exciting things about Tesla that make it really hard not to want to own it, despite the fact that in Q1 they put up 9% revenue declines and are currently
Hmm.
trading well over 100 PE.
Yeah, so their revenue for year 2024 was about $100 billion. This quarter they did about 20 billion. So if you annualize that, that's a 80 billion or a 20% drop in revenue. Uh, so not great if you're just
Well, yeah,
looking
but
at
but Q
what happened
Q1s are
this
always going
quarter.
to be way smaller than Q4s,
Yeah,
so you can't really
and
annualize
there's
the Q1 revenue.
definitely not. And there's so many other things that happened in Q1. They specifically picked Q1 because it's the slowest quarter to change over. Every single one of their factories lines over from the old Model Y and Model 3 to the new Model Y and Model 3. So they had a couple of weeks of downtime where they produced literally zero vehicles. So just to think that they only lost 9% revenue whilst not producing cars for basically a third of the quarter, which is pretty crazy to think about. So they are still executing at an incredible rate if you really think about what they did, what they executed. They changed the over number one selling car in the world's production line over in such a short period in multiple geolocations at the same time. So just an incredible ability to execute um, worldwide at all of their
Yeah.
locations.
Okay. So for this year, we're expecting them to put up slight revenue growth overall, partly because they are supposed to announce a cheaper model sometime in the next well, really in the next month, if they're going to hit the first year or the first half of 2025
Yeah.
for this car deployment. And they should start chipping it like very close to the announcement. So we do expect some volume from it this year. And then we expect some resurgence bounce back because they're not refreshing the Model Y in Q2, 3, and 4.
Hmm.
They have a brand new refreshed Model Y, which can hopefully do some decent sales. So just very modest growth from 97 billion in revenue last year to 107 billion in revenue this year. And then we expect over the next 5 years, we do see some decent growth from newer models, from robotaxi starting to ramp, from the energy business continuing to grow really well, and just generally from like interest rates getting cut, going into more of like a cyclical bull market for automotive. I think could be a tailwind for them as well. So we're saying that they could hit 30% revenue growth for the next 5 years annualized. This will obviously be less in the short term and can maybe, accelerate as they start rolling out robotaxi more, on the later half of that 5 year period to hit that 30% annual growth
Yeah.
rate.
Only half of that 400 billion in 5 years is going to, we believe, is going to be from auto manufacturing, which now it's obviously a very high percentage of their total revenue. And we're expecting the auto manufacturing revenue to quickly drop to 50% of Tesla's revenue as this, robo taxi story really develops. You can see, Waymo's already doubling their fleet, doing, tens of thousands of rides, number one, more busy than a human driver in the markets that they're already in. So I think the demand is right there. I know for me personally, I cannot wait for this to become available. I'm literally never going to own a car again. And I think whilst a lot of people love cars, there's definitely a percentage of the population that are like that. A lot of people are like me, and they just want to get from point A to point B the most efficiently and cheapest way possible. And this is going to quickly become far cheaper than owning your own vehicle. So I think the total addressable market here is absolutely massive. And I think Tesla is, even though they're not the first to market, in certain cities, like that's, I think it's an important distinction. Like a lot of people are like, oh, Waymo's first to market. They're first to market in San Francisco, Phoenix, and Austin. That's it. So they're first to market in three markets. When Tesla comes out, they are going to be able to scale so much faster than Waymo. They're going to be the first to market in like 99% of the United States. And then beyond that in other, countries as they get regulatory approval. So I think
Yeah.
in hindsight, a lot of people are going to pretty much think of Tesla as the first to market in their country, in their hometown.
Yeah, that's very possible. And regardless of who's first, who picks up the phone first, the deal has to be made. As Trump said
Mm,
about China recently, who cares who was in the market first? It's like whoever has the best product
yeah,
at the best price is going to win, and the market's big enough, I think, for several really big
yeah,
winners.
definitely.
For sure. So then the next 5 years, 20% revenue growth, and then 15% revenue growth the next 10 years. So 20 years out, so sorry, 10 years out, we're expecting almost $1 trillion in revenue, and then 20 years out, $4 trillion in revenue. And I know
Yeah, in
that,
10 to 20 years,
yeah,
the story
it's,
also adds humanoid robots in there, which is
yeah,
crazy.
yeah.
We're not even assuming
And
anything with humanoid robots in the next 5 years.
yeah, and it's like even if robotaxis failed, which they're not, and even if robots failed, which they're not, you still have energy, which is going to put up insane growth, and could easily get to hundreds of billions of dollars in annual revenue, or more. And then you have the fact that Tesla can scale way bigger with just auto, with with like a van and some cheaper models and stuff like that as well. So I think they could just 10x just with auto if they needed to, even if they weren't also an AI company, but that would be far more risky. All
Yeah.
right, you want to talk about profit margins?
Yeah, just one more thing on the Tesla revenue. I have an assumption that in 20 years they might be making zero revenue from cars because they won't be selling cars anymore. It's like you could play the Kramer clip from Iron Man 1 where he says it's a weapons company that doesn't sell weapons.
Stark Industries. I've got one recommendation. Ready? Ready? Sell, sell, sell. Abandon ship. Does the Hindenburg ring any bells? Let me show you the new Stark Industries business plan. Look, that's a weapons company that doesn't make weapons.
I think Tesla story might eventually become it's a car manufacturer that doesn't sell cars. They just sell, autonomous chips, robots. It's so very, very exciting story. Again, like we mentioned at the beginning. Going into revenues, obviously, again, going
Profit
off this last
margins.
quarter. Oh, yeah, sorry, profit margins. Not looking super hot in the short term, and that's reflected in our 1 year profit margin target, about 5%. What was their profit margin this last quarter?
Well,
Let
last quarter
me
was like
find it.
2% because they had
Yeah,
factories shut down.
yeah.
So yeah, they could easily be 5%, but then 5 years out, we have them at 15%, which they were at 15% already. Before interest rates got raised in this last cycle. They were very profitable in a ton and like very high demand. They were just raising prices and stuff because the
Hmm.
demand was so high and the wait lists were so high. It's like it feels so long ago.
Yeah.
That
Couple of rate
was the
cuts
Tesla
can bring us
story.
back.
Yeah, potentially. But yeah, so 15% would just be getting back to 15% profit margins, but then longer term, 10 years out, we have them getting to 25% profit margins. And then super long term, 20 years out, with autonomy and maybe even autonomous robots and that sort of thing. We have in here that they could potentially get to, 35%
Yeah.
uh net profit margin
And a lot of that
ranges.
is because a lot of their profits going to be coming from software. So a lot of the value of the humanoid robots will be the software that's in them. So that's going to demand a premium. Same for the autonomous taxis. That's mostly just almost pure profit and pure profit on every single ride as well. That whatever percentage of the rides that profit of the rides that Tesla takes is almost pure profit for them as well.
Yeah,
So
like
they can get
there's
some pretty insane profit margins in the future.
it's very unlikely they could get to 35% profit margins just being a hardware company. Like if they were
Yeah,
just selling cars for a 35% profit, at least they couldn't get to the sort of scale that we're talking about them getting to and have that sort of profit margins just
yeah,
as a car
definitely.
company. Okay, so then multiple wise,
Yeah,
5
that
years
needs
out,
to come
we
down.
assume we assume that they're going to trade at a 65 multiple, then 10 years of 40 multiple, and 20 years at 35 multiple, which is
Yeah.
the highest of them all. So just remember again here, for Lemonade, when we show these charts here, which we're about to pop up, for the 20 years out, we're expecting Lemonade to trade at a 25 PE, Hims a 30 PE, and Tesla a 35 PE. So we're looking at Lemonade as the lowest multiple to get to its return, and Tesla's the highest multiple to get to its return.
Do we want to talk about the 1 year and 5 year, or only the 10 and
Uh,
20 year?
just 5, 10, and 20. So
Okay.
go ahead and read off the numbers for them.
Yeah, so we expect in 5 years, for every dollar you put into Lemonade, or no, so we'll start with Hims. For every dollar you put into Hims, it'll be worth about $5.5.
Based
For
on all
Lemonade,
those assumptions that we ran through.
yeah. So 5.5x return on investment. For Lemonade, a 4.3 x return on investment, and then Tesla, a 4.3x return on investment in 5 years.
Yeah, so they're all in that, 4 or 5x ballpark, 5 years out. Really, I think if you had to guess which one's gonna have gone up the most 5 years out, um, your guess is as good as mine.
Yeah,
I,
no, it's,
Definitely Hims has the most momentum with it right now, but
mhm.
if their revenue growth is really going to slow to 22% a year, from 100% this year, I think some
Yeah,
of
it
that
could crash.
enthusiasm could definitely disappear over the next 5 years. Although like 22% annual growth would still be solid, but I think current
Yeah.
investors with the current momentum and hype, with it going up 20% a day, they would be disappointed. They wouldn't be bidding it up like it is maybe if they thought it was only going to have 22% annualized growth going forward.
hmm So then going to the 10 year, for Hims, we're expecting a 13x in 10 years, Lemonade a 23x in 10 years, and then Tesla come in last place with still an incredible 11 x ROI in 10 years. So again, that's just if you put $1 in, it's going to be worth $11 for Tesla, $13 for Hims, and $23 for Lemonade.
Yeah, and that's really great returns. I mean, over a decade, 10xing is really solid. I mean, 20xing on Lemonade is insane sort of returns. Like you'll be beating the market for sure if these play out like this.
Yeah, the S&P 500, I think at 8% annual growth rate means you double your money every 7 years or so. So every $1 you can expect to turn into $2 every 7 years in the S&P 500.
Yeah. So 10xing in 10 years is really good.
It's
Or
really
11x,
good.
23xing. All right.
Yeah,
So let's look at the 20-year return on investment outlook now.
yeah. So for 20 years out, this is life-changing X's here. Like we're expecting a 56 bagger, as Peter Lynch likes to call them baggers. So 56x on Hims, 101x on Lemonade. So we expect that to be a 100 bagger in 20 years, and then Tesla a 55x in 20 years as well, which is insane
Yes.
for a company the size of Tesla to grow that much.
Yeah, we're talking about Tesla getting close to like a $50 trillion market cap, or something like that,
I mean, yeah, I
which
can see the exact market cap we're assuming.
yeah, which sounds like really crazy, but I've thought Tesla could get to the 50 trillion range for a while, and people thought I was crazy for a while. And you probably think I'm crazy as well, but that's okay. For Lemonade to 101x though in 20 years, they only have to become like a $2.3 billion, or sorry, $230 billion company.
Yeah, I'll just read out the market caps real quick so they have that too. So we're assuming that in 20 years, I'll just read the 20-year one. Hims will be a $647 billion market cap. Lemonade will be a $232 billion market cap. And then, yeah, Tesla is a $49 trillion market cap,
Yeah, and
which
even
sounds
though
crazy now when the most expensive company is worth, 3 trillion or whatever, not even. But, this is 20 years. Inflation's going to make that look a lot smaller in 20 years. And then also, the amount of abundance these companies are going to be producing is just not going to be comparable to today either. So
Yeah. I do want to point out something very interesting here on the 20-year thing. So even though we have Lemonade at 101x compared to a 50x for the other two, Lemonade for that 101x, we are assuming the smallest overall market cap, the lowest gross profit margins, and the lowest PE multiple.
Hmm.
So we literally are assuming that it's the smallest after the 20 years, the least profitable, and the least rewarded by the market in multiple, and it still has more than double the returns of the other two stocks. So
Yeah.
that's the reason why it is my biggest position
Hmm.
personally.
Yeah. Um, I'm going to make it my biggest position most likely if it doesn't run up too much in the next couple of months. I'm currently getting ready to sell a house. So I am hoping that it doesn't run up too much in the next couple of months so that I'm able to really build out a position. Currently, my largest position is Tesla. And that's been pretty much sideways for the last 4 years, but I'm totally fine with that. I love what Antonio Lonaire says. He says Tesla stock has been sideways, but now the cars drive themselves. So pretty bullish thesis, I think. So I'm still happy, even though I haven't seen a return really the last 4 years on Tesla. My thesis remains the same for them as well, and so I think I'll still see outsized returns, even though the stock price didn't move for the last 4 years. And I think that's a really important thing. Like we're talking about crazy returns; these aren't going to happen linearly in a
Yeah.
linear. There we go, in a linear fashion.
Linearly. Yeah.
These
No,
aren't
for
going to happen
sure.
linearly.
And then I
So
should also note that even though Lemonade does have the highest returns from here, one of the reasons is because it is priced slightly more conservatively by the market than a Tesla or a Hims because it's not profitable yet. Which means that it does have some additional risk that
mhm.
no longer exists for Hims and Tesla.
Yeah,
So one of the ways the market works is that it's like, okay, if you're willing to take on a bit more risk, we'll give you a bit more reward as well. So I think it's actually kind of reasonable that Lemonade has a bit higher outlook here because you are taking slightly more risk. I don't think you're taking that much more risk because I see how the numbers work out, but you're trusting management is going to get the company to profitability and then get them eventually to a decent profit margin. Whereas for Hims, for example, you can see, oh, look, they already have decent profit margins. They just have to, continue improving their profit margins like they have been. Now, Lemonade has been improving their profit margins as well. So you also only need to believe they're going to continue improving like they have been. But I think in an investor's mind, it can seem like such a big difference between loss-making and profitable company, even though you might look at like the trajectories and see the exact same trajectories for a loss-making and profitable company. Like they could both be increasing profitability and have like that same sort of trajectory. They're just at different stages in that
yeah.
profitability
If I
cycle.
can touch on too with Lemonade, they just gained cash flow profitability, which is our positive cash flow positive, which is it's an important, like this is going to be really nerdy here for a second. So when you're talking about accounting, you can do accounting in two ways. You can do accrual accounting and you can do cash accounting. So I think cash flow is a lot more like similar to what cash accounting is, whereas like net profit and all of that net income, that's done through accrual counting, which accrual counting has all of these weird rules about when you can recognize profit. So you can have the dollar in your bank account, but you can't recognize that it's profit yet. And vice versa, you can, have paid out an expense and then, recognize that expense over the next couple of years. So there's a bunch of funky things. I think that's why a lot of people really don't care about, EBITDA or not EBITDA, net margin, net income. They care about free cash flow because, that's really the actual dollars the company is seeing. And for the first time already this year, Lemonade's actually seeing an increase in the actual amount of dollars that they have. So you're talking about some book value compression. Maybe that isn't the case if they're starting to see an increase in dollars on their balance sheet. Maybe that book value actually starts to increase already, or they decide, to increase their marketing spend, which I would probably be more preferential towards because I want to see the company grow faster. So, I think that's an important thing to keep in mind is, there's so many nuances to how companies are valued, how they recognize profit. So it's a lot to take in to really understand what's happening in a company. Um, so I'm still learning a ton. I just learned about the cash versus accrual counting and all that because some people are like, oh, I only care about net income or I only care about free cash flow. I'm like, what's the difference? So yeah, it's keep learning. There's a lot more to learn, and we're definitely still learning. We don't know it all, so we're definitely wrong. Like these are definitely not the exact numbers that are going to come out in 20 years. We're not going to get to year 20 and be like, oh, my lemonade is exactly a 101.536 return. Like this is not going to happen. But these are, I think, educated guesses. And if, we're right, 60+% of the time, I think, which we definitely can be, by putting in the work, putting in the time to understand the fundamentals, we're going to have, and you're going to have, if you do the same
And
thing,
we just have to be
far better.
directionally right as
Yeah,
well.
yeah. Uh-huh. Exactly. You're going to have so much better returns, picking individual stocks than investing in the S&P 500.
Yeah, for sure. So, thank you guys so much for watching this video. If you did enjoy it, remember to drop a big thumbs up and subscribe for more content from us in the future. Let us know how much you disagree with our estimates, or
Yeah.
whether or not maybe you do agree with them. And
Mhm.
then also if there is a specific stock that you would like us to run numbers on, and that you would like to see covered in the future, let us know in the comments below. And until next time, everyone, invest safe. Actually, get good return. Okay. Until next time, everyone, invest safe.